He ran one of the most trusted banks in America. He served the smartest founders in Silicon Valley, and in 48 hours, he watched $42 billion walk out the door. This is the story of Silicon Valley Bank, the bank that funded half of tech's biggest names, and how a single tweet thread killed it faster than any bank run in history. And the wildest part? Nobody saw it coming, not even the people whose job was to see it coming. Santa Clara, California, 1983. A poker game between two Bank of America executives. Not a boardroom, not a pitch deck, a card table. We keep losing founders to banks that don't understand them. So, build one that does. That's how Silicon Valley Bank was born. A bank built specifically for an industry nobody else took seriously yet. Tech startups with no revenue, no collateral, just an idea and a dream. For 40 years, it worked. SVB didn't just bank startups, it became the plumbing of Silicon Valley itself. Nearly half of all US venture-backed startups banked there. Founders didn't just keep money there, they lived there, financially speaking. Payroll accounts, venture debt, personal mortgages, all under one roof. By 2021, SVB was sitting on something extraordinary. During the pandemic tech boom, startups raised record amounts of venture capital, and all that cash needed somewhere to sit. SVB's deposits exploded from $60 billion to over $190 billion in less than 2 years. We have more money than we know what to do with. So, what did they do with it? They did what banks do. They invested it. Except this time, they made one enormous bet. Long-duration bonds and a fatal bet. SVB took a huge chunk of that deposit flood, tens of billions of dollars, and poured it into long-term government bonds and mortgage-backed securities. Safe investments, in theory. The kind regulators love. The kind that never make headlines. Interest rates are near zero. They're not going anywhere for years. That was the bet. Lock in low yields now, ride it out for a decade. Then the Federal Reserve did something SVB's models never seriously priced in. Starting in March 2022, the Fed raised interest rates aggressively, again and again and again, the fastest rate hiking cycle in 40 years. And here's the part almost nobody outside finance understands. When interest rates rise, the value of existing bonds falls, not slightly, dramatically. SVB was holding bonds paying 1.5% interest, while the market now offered 4%, then 5%. Nobody wanted SVB's old bonds anymore, not unless they came at a steep discount. By the end of 2022, SVB was sitting on $15 billion in unrealized losses on those bonds. On paper, still technically solvent. In reality, a bank quietly bleeding out, and almost nobody watching from the outside knew it yet. The tweet that broke a bank. March 8, 2023. SVB announced it needed to raise $2.25 billion in emergency capital. They'd sold a chunk of that bond portfolio at a steep loss to cover withdrawals, and now they needed fresh cash to plug the hole. We're being proactive. This is a routine capital raise. It wasn't routine, and Silicon Valley doesn't do routine panic. It does group chat panic, instant, synchronized, and merciless. Within hours, venture capital firms started messaging their portfolio companies, not suggesting caution, instructing withdrawal. Get your money out, now. Don't wait to see what happens. Peter Thiel's Founders Fund reportedly pulled its funds out almost immediately. Once one major fund moved, the dam broke. Because in the age of instant transfers and group texts, a bank run doesn't take weeks anymore. It doesn't even take days. Founders sat in their offices, laptops open, initiating multi-million-dollar wire transfers with the same casual motion they'd use to order lunch. No lines outside branches, no dramatic footage of anxious customers, just quiet keystrokes, thousands of them, all at once. In a single day, March 9, 2023, depositors pulled $42 billion out of Silicon Valley Bank. $42 billion in roughly 10 hours. That is, adjusted for the speed of digital banking, one of the fastest bank runs in American history. By the morning of March 10th, California regulators had seen enough. They shut the bank down and handed control to the FDIC. The 17th largest bank in America, gone in 48 hours. The contagion. Here's where it stops being one bank's problem. Thousands of startups suddenly couldn't access payroll. Companies with tens of millions of dollars sitting in Silicon Valley accounts above the $250,000 FDIC insurance limit had no idea if they'd ever see that money again. I have 40 people relying on me for their paycheck this Friday, and I don't know if I can pay them. That wasn't one founder, that was thousands, all posting some version of the same panicked message within hours of each other. Roku had $487 million stuck inside SVB. Roblox had around $150 million. Etsy delayed payments to sellers because the money simply wasn't moving. This wasn't a startup problem anymore. It was cascading into companies the average person actually recognized. And it didn't stop at SVB. Within days, Signature Bank collapsed too, spooked depositors fleeing anything that looked remotely similar. Then came pressure on First Republic, another lender to wealthy tech clients, which would collapse just weeks later in the largest bank failure since 2008. Regulators panicked. Over that weekend, the Treasury, the Fed, and the FDIC took the extraordinary step of guaranteeing all deposits at SVB, even the ones above the insured limit. Something they insisted, repeatedly, was absolutely not a bailout. No losses will be borne by the taxpayer. Technically true. Functionally, it was the government stepping in to stop a fire from spreading, because letting Silicon Valley's cash evaporate would have taken far more than one bank down with it. The aftermath, and the myth that followed. By the time the dust settled, SVB CEO Greg Becker walked away with roughly $9.1 million in compensation from the year before the collapse. Executives had sold company stock in the weeks before the bank failed, timing that later drew scrutiny from lawmakers and lawsuits from angry shareholders. Congress held hearings. Becker testified, calm, rehearsed, careful. In hindsight, the speed and size of the withdrawals were unprecedented. Unprecedented is one word for it. Predictable, in retrospect, might be another. Analysts had flagged SVB's interest rate exposure in reports months before the collapse. The warnings existed. Almost nobody outside finance media read them, and almost nobody inside SVB acted on them with any urgency. The bank was eventually sold off, its remains absorbed by First Citizens Bank. The name Silicon Valley Bank, once synonymous with trust founders, became shorthand overnight for exactly the kind of institutional fragility everyone assumed had been fixed after 2008. The venture capitalists who triggered the run faced almost no consequences. The founders who lost sleep for 72 hours mostly got their money back, thanks to that emergency guarantee. The employees who lost their jobs when SVB was dissolved did not get a government backstop. Neither did the smaller banks that failed in the contagion that followed, institutions with far less star power and far less sympathy. And somewhere in Menlo Park right now, another bank executive is looking at a balance sheet full of long-term bonds, betting that rates won't move much, telling themselves this time is different. Because here's the uncomfortable truth underneath this entire story. Every single decision that destroyed Silicon Valley Bank was on its own defensible. Buying government bonds isn't reckless. Serving startups isn't reckless. Even the group chat that triggered the run wasn't malicious. It was just fear moving at the speed of a text message. Nobody set out to break the bank. They just each made a rational, self-interested choice at exactly the same moment, and $42 billion vanished before anyone had time to ask if it was actually a good idea. You've probably got a banking app on your phone right now. Somewhere behind that clean interface sits a balance sheet you've never looked at, sitting on assets you've never questioned, run by people betting on a future they're guessing at just like everyone else. The next SVB isn't going to announce itself with a poker game or a boardroom memo. It's going to start exactly like this one did, quietly, reasonably, and completely invisible, right until somebody hits send.